In this section, we will discuss margin accounts and trading on margin. A margin account is an account that allows a customer to borrow from her broker-dealer in order to be able to purchase more securities than she could if using only her own money. Such trading increases the potential for gains, but it also increases the potential for losses, and thus it is not suitable for customers who lack the appetite to take on a heightened level of risk. Margin customers must pay interest on their loans, and cash and securities in a margin account are held as collateral for those loans. SEC Regulation T requires an initial deposit of 50% of the value of securities purchased or sold short in the account. The remainder can be margined or loaned to the customer from the broker-dealer. Under Regulation T, the initial requirement is a bit different if the first trade in the account is for a relatively small amount. The initial margin requirement is 100% if the transaction is for less than $2,000, and $2,000 if the transaction is anywhere between $2,000 and $4,000. A margin customer has an ongoing minimum maintenance requirement of 25% of long market value, LMV, or the value of securities held in the account. If LMV drops below 25%, the broker-dealer can make a margin call to the customer, requiring her to deposit more funds in the account. Or the broker can sell securities in the account to increase cash and pay off the loan. When an investor buys shares on margin, she is said to be long the shares. This means that she owns the shares, even though they are not 100% paid for. The value of securities in a long margin account is called long market value, or LMV. LMV is equal to the market price of the security times the number of shares. Equity is another important factor when considering long margin accounts. Equity in the account is the amount of the securities that the customer has paid for. Debit balance is also an important consideration for a long margin account. It is the money that the customer borrowed from the broker-dealer. The relevant equation for a long margin account, and one that you should be sure to memorize, is LMV minus debit balance equals equity. Here's an example of a long margin account. Sharon buys 1,000 shares of XYZ in her margin account when XYZ is trading at $25. She puts the required 50% equity into her account. Thus, the following equation represents her margin account. LMV of $25,000 minus debit balance of $12,500 equals equity of $12,500. When the value of the securities in a long margin account changes, the LMV and equity will automatically change. However, the debit balance will remain the same. Remember, the debit balance is the money loaned by the broker-dealer, and that will not change with shifts in the price of the securities. LMV will rise or fall depending on the market value of the securities. The equity will also fluctuate, but it will still be the difference between the LMV and the debit balance. For example, say Sharon's XYZ shares from the previous example increase in price to $30 a share. Her LMV will rise to $30,000. $30 times 1,000 shares equals $30,000, and her debit balance will remain at $12,500. Since the difference between the new LMV and her debit balance is $17,500, this amount represents Sharon's equity in the account. This is shown by inputting the new numbers into the long margin account. LMV of $30,000 minus debit balance of $12,500 gives equity of $17,500. When the price of the securities in a margin account rise so that the account's equity is greater than 50% of its LMV, the account holder is said to have excess equity. When a long margin account has excess equity, that equity is put into a special memorandum account, or SMA. Remember Sharon's margin account, represented by the equation LMV of $30,000 minus debit balance of $12,500 equals equity of $17,500? This account would have excess equity of $2,500. This is because 50% of LMV is $15,000, and the account's equity is $2,500 in excess of that amount. Thus, we can adjust the account equation to read as you see here. LMV of $30,000 minus debit balance of $12,500 equals required equity of $15,000 plus the SMA of $2,500. Note, an investor can use her SMA to purchase securities with an LMV of up to twice the value of SMA. So this means that SMA comes with buying power of 2 times SMA. To meet the minimum maintenance requirement for a long margin account, the customer must maintain an equity of at least 25% of the account's long market value at all times. If the equity in the account drops below the 25% level, the customer will need to deposit securities or funds to raise the account back to that level. If the customer fails to do so, the broker-dealer will sell off the customer's securities to meet the requirement. Let's return to Sharon for an example related to price decreases and minimum maintenance in a long margin account. Say the value of XYZ plunges to $15 a share. Sharon's LMV would now be $15,000. $15 a share times 1,000 shares equals $15,000. Her debit balance remains at $12,500, but now her equity is $2,500. The equation is LMV of $15,000 minus debit balance of $12,500 equals equity of $2,500. 25% of $15,000 is $3,750. So this is the amount that Sharon must have in equity in her account, her minimum maintenance requirement. However, as you can see, the equity in her account is only $2,500. This means she must deposit the difference between that amount and the minimum maintenance requirement, or $1,250 into her account. That amount will raise the account's equity to the required level. Here's a question about long margin accounts. Shay opens a margin account with Edge Brokerage. He goes long 2,000 shares of ENGN at $40 per share and puts down 50% to buy the securities. 2 months later, ENGN's share price has dropped to $25. How much money does Shay need to put into his account to meet the minimum maintenance requirement? And the correct answer is $2,500. When Shay buys the shares, their value is $80,000. 2,000 shares times $40 per share, and Edge loans him half of this amount, $40,000. Thus he has $40,000 in equity. When the price drops to $25 per share, the value of his account is $50,000. And since he still owes $40,000 to Edge, his equity is now $10,000. LMV of $50,000 minus debit balance of $40,000 equals equity of $10,000. This means his equity is now only 20% of the account's value. 10,000 divided by 50,000 equals 0.20, and he must increase that equity to 25% in order to meet his minimum maintenance requirements. To do so, he needs to deposit $2,500. You can figure that out by doing the math here. $50,000 times 0.25 equals $12,500, and $12,500 minus $10,000 equals $2,500, which again is the correct answer. Now let's look at short positions in margin accounts. A short sale, or selling short, is the sale of securities in anticipation of a price decline. In a short sale, securities that are borrowed from a broker-dealer are sold by an investor and later replaced by purchasing identical securities. Let's look at an example for context. Eustacia shorts 1,000 shares of ABC for $30 a share. To do so, she borrows 1,000 shares from her broker-dealer. She never actually owns the shares, which she sells, in turn receiving $30,000 for her short sale. 5 days later, when ABC is trading at $27 per share, she purchases 1,000 shares to deliver to her broker-dealer. She pays $27,000 for those shares. Thus, her short sale transaction netted her $3,000. $30,000 received for her short sale minus $27,000 paid for the replacement shares equals $3,000. A short sale must occur in a margin account, and an investor must deposit the money from the short sale plus at least 50% of the short market value of the securities into his account. This means the customer needs to put at least 150% of the value of the securities into his account. The relevant equation for a short margin account, and one that you should memorize, is credit balance minus SMV equals equity. Note that the credit balance will be 150% of the SMV, and the equity is the difference between the credit balance and the SMV. Here's an example that deals with a short margin investor in his account. Ali opens a margin account and shorts 500 shares of ATCQ at $50. The SMV of the shares is $25,000. $50 times 500 shares equals $25,000. He receives this amount and deposits it into his account. Ali must also deposit equity that is equivalent to 50% of the value of the securities, which is $12,500. $25,000 times 0.50 equals $12,500. This additional amount is represented in the equity column of the equation below. His credit balance is $37,500. $25,000 plus $12,500 equals $37,500. And here's the relevant equation. Credit balance of $37,500 minus SMV of $25,000 equals equity of $12,500. When the value of the shorted securities in a margin account declines, the account's SMV decreases, while its credit balance remains the same. As a result, the account's equity rises, and this is good for the account holder. So back to Ali's account from the previous example. Remember that the SMV of his shares of ATCQ is $25,000, $50 per share times 500 shares. Say the price of ATCQ drops to $40 per share. His SMV is now $20,000. $40 per share times 500 shares equals $20,000. His credit balance remains at $37,500, so this means his equity is now $17,500. You can see this by looking at the equation credit balance of $37,500 minus SMV of $20,000 equals equity of $17,500. When the equity in a short margin account exceeds 50% of the SMV, the account holder has excess equity, and that equity will be placed in a special memorandum account. So back to Ali's short margin account, which is represented by the equation credit balance of $37,500 minus SMV of $20,000 equals equity of $17,500. Since 50% of the account's SMV is $10,000 and Ali has $17,500 in equity, this means he has excess equity of $7,500. $17,500 minus $10,000 equals $7,500. That $7,500 will be placed into an SMA, and thus his account is now represented by the equation credit balance of $37,500 minus SMV of $20,000 equals required equity of $10,000 plus SMA of $7,500. A short margin account holder must keep at least 30% of the short market value in equity in the account. This is the minimum maintenance requirement. To find the amount at which a short margin account will get a margin call, meaning the point when an investor will need to deposit additional funds to the account, divide the account's credit balance by 1.3. In addition, a customer is always required to maintain at least $2,000 in a short margin account, regardless of the account's SMV. When the price of the securities in a short margin account rises, there are negative consequences for the investor. If the SMV rises higher than the value of the account's credit balance divided by 1.3, the investor will need to deposit the amount that will bring his equity up to 30% of the SMV. So for example, say Martina shorts 100 shares of PTB when it's trading at $50 per share. Her SMV is $5,000, and she must also deposit 50% of that SMV, or $2,500 in equity, to her account. The equation is credit balance of $7,500 minus SMV of $5,000 equals equity of $2,500. If her SMV then rises above $5,769.23, $7,500 divided by 1.3 equals $5,769.23, she will receive a margin call and need to deposit additional funds. So say that the value of PTB suddenly rises to $65. Martina's SMV is now $6,500. $65 per share times 100 shares equals $6,500. And her account is now represented by the equation credit balance of $7,500 minus SMV of $6,500 equals equity of $1,000. Since her SMV is above $5,769.23, Martina must deposit additional funds. But how much? Well, her equity must be at least 30% of her SMV, and since 30% of $6,500 is $1,950, Martina must deposit at least $950 into her short margin account. $1,950 minus $1,000 equals $950. And here's a short margin account question. Calvin opens a margin account with a short market value of $100,000 and a credit balance of $150,000. What short market value does the account need to reach before Calvin receives a margin call? A. $76,923, B. $105,000, C. $115,385, or D. $166,670. And the correct answer is C. $115,385. The minimum maintenance requirement for a short margin account is 30% of the current short market value of the securities. To find the value at which a short margin account will get a margin call, divide the credit balance by 1.3 or 130%. Doing so here gives a value of $115,385, which is the correct answer. $150,000 divided by 1.3 equals $115,384.61, which is rounded up to the next whole dollar value. Naked short selling occurs when a short seller does not borrow or arrange to borrow securities in advance of selling them. Regulation SHO says that before a broker-dealer can execute a short sale, it must locate the securities that will be borrowed for the short sale. For the purposes of Regulation SHO, locate means the securities have already been borrowed, or there is a bona fide agreement to borrow them in place, or the broker-dealer has reasonable grounds to believe that the securities can be borrowed by the settlement date of the transaction, which is the trade date plus 2 additional business days. A broker-dealer is said to have reasonable grounds for belief if the security is on the firm's easy-to-borrow list, and that list is less than 24 hours old. Additionally, the process of locating the securities in question must be documented by the firm. Day trading is when a customer buys and sells the same security on the same day to try to take advantage of small changes in the market. Day trading, like short selling, must take place in a margin account. Unlike regular trades purchased on margin, which have buying power of 2 times the account's SMA, day traders get to have buying power of up to 4 times any equity over 25% of the market value of the securities. So for example, if a day trading account has $1,000 in equity above this 25% level, its holder can purchase up to $4,000 in additional securities. By definition, a pattern day trader is any customer who executes 4 or more day trades within 5 business days. A pattern day trader must open a day trading account. FINRA requires such an account to have a minimum equity of $25,000 on any day that trading occurs. Member firms that promote day trading strategies must do the following before opening an account for a customer. Provide the customer with a document that outlines the risks of day trading, and either receive a written statement that the customer does not intend to day trade, or approve the account for day trading based on whether the member believes the day trading strategy is appropriate for the customer. To determine the appropriateness of day trading strategies for a particular customer, the broker must learn the customer's investment objectives, trading experience, and knowledge of the market, must collect financial information, and must obtain information about the customer's employment status, marital status, number of dependents, and age. Not all securities can be purchased on margin. So let's look at the specific types that can and some that cannot. First, securities that can be purchased on margin. Any non-newly issued securities listed on an exchange, such as NASDAQ and the NYSE, meaning securities that have been available to the public for more than 30 days, can be traded on margin. Also, U.S. government and municipal securities, as well as over-the-counter securities that are listed on the Federal Reserve's marginable securities list, can be traded on margin. Securities that specifically cannot be purchased on margin include new issues, meaning securities that have been traded publicly for fewer than 30 days, mutual fund shares, and put and call options. Options must be paid in full. However, although they cannot be purchased with borrowed money, they still must be purchased within a margin account. Let's close out our discussion of margin with a couple of practice questions. Sean opens a new margin account by purchasing 200 shares of limited XYZ at $8 per share. How much does he need to deposit as an initial margin requirement? A, $400, B, $800, C, $1,600, or D, $2,000? And the correct answer is C, $1,600. Regulation T sets the initial margin requirement at 50% for a margin account. This means that clients typically must deposit half of the value of the securities in the account when making the first purchase in the account. However, margin accounts also have minimum deposit requirements for the first transaction. For a long margin account, such as Sean's, a purchase of less than $2,000 requires 100% of the value of the purchase. Thus, Sean needs to deposit $1,600 in his account. 200 shares times $8 per share equals $1,600 LMV, which is the amount that he needs to deposit. And now a final question. Frida purchases 500 shares of Wildcard Incorporated on margin at $22 per share. She deposits the initial margin requirement into her account. Later that day, Wildcard stock shoots up to $30 per share. How much excess equity has been created in Frida's account as a result of this gain? A, $5,750, B, $2,000, C, $1,000, or D, 0. And the correct answer is B. Frida's initial LMV is $11,000. 500 shares times $22 per share equals $11,000. And under Regulation T, she's required to deposit half of that amount as equity in her account, which is $5,500. Her debit balance will also be $5,500, and her account is represented by the equation LMV of $11,000 minus debit balance of $5,500 equals equity of $5,500. When the price of Wildcard rises to $30 a share, the LMV in Frida's account increases to $15,000. 500 shares times $30 a share equals $15,000. Her debit balance remains at $5,500, making her equity $9,500. And look at the equation here. LMV of $15,000 minus debit balance of $5,500 equals equity of $9,500. Frida's required equity is 50% of LMV, which is $7,500. $15,000 times 0.5 equals $7,500. And any equity beyond that amount is considered to be excess equity. So she has $2,000 in excess equity. $9,500 minus $7,500 required equity equals $2,000 excess equity.